for our first panel today in our first hour. From the Office of the Superintendent of Financial Institutions, we have the Superintendent, Mr. Peter Rutledge. Welcome, sir. And the members look forward to your opening remarks and then to asking you questions. So the floor is yours.
Merci beaucoup. Bonjour, Monsieur le Président.
Thank you, Mr. Chair and committee members. Thank you for inviting me back in support of your study of the public policy decisions and market forces that have led to increases in the cost of buying or renting a home in Canada.
The published annual risk outlook, we remain intently focused on the key risks facing the Canadian financial system, including real estate secured lending and mortgage risks, wholesale credit risks, funding and liquidity risks, and integrity and security risks related to the geopolitical environment. With respect to the topic under investigation by this committee, I note that higher mortgage payments are taking up a larger part of some households' income, leading to more borrowers finding it difficult to pay their loans and debts. We expect rising debt service costs to be a key risk for financial institutions and their customers for the next 2 years. Having said that, I note that mortgage and household credit quality remains high by historic standards. Membres du comité, le BCF, tout comme ses partenaires fédéraux.
Committee members, we, along with our federal partners, want Canadians to access and maintain mortgages throughout the ups and downs of market cycles. And part of my role, as Superintendent of Financial Institutions, is to ensure that lenders exercise prudence in underwriting mortgages and sound risk management throughout the life cycle of those loans.
Prudential rules for mortgage lending foster a safe, stable financial system and help keep Canadians in their homes over the long term. It's our job to make sure that lenders remain resilient while adapting to evolving risks in financial markets. And with that, I'll be pleased to take your questions.
Rutledge, and I'm sure the members have many questions, and we are starting our first round with each party with up to 6 minutes of questions. We'll start with MP Chambers for the first 6 minutes.
Thanks, Mr. Chair. Welcome back, Mr. Rutledge. Thank you for your service to the country and keeping our financial system safe. The Competition Bureau has recommended that that we consider changing the stress test for people who are with uninsured mortgages. The government has changed the requirements, or at least indicated that those who are insured don't have to do a stress test on renewal, so they can shop around and get a new lower mortgage rate. Is OSFI considering changes?
Thank you, Mr. Chair. So to start with the facts, the member is absolutely right in his facts. If you have an insured mortgage and you seek to renew it in an alternate lending institution, you don't have to go through a mortgage stress test or any other underwriting check. By contrast, if you have an uninsured mortgage, you do. And that is an imbalance. And the Commissioner of the Competition Bureau and I have spoken about that. From our perspective, our job is to make sure institutions underwrite mortgages safely. And one of the core principles of underwriting mortgages is, if you have a new credit, do all your underwriting discipline. And so in our view, for uninsured mortgages, which B20 applies to, we ask lenders to underwrite new customers in full. Meanwhile, that doesn't apply for insured mortgagors because they have purchased a mortgage insurance policy.
Okay, I'm going to run out of time. So the question is, are you reconsidering for uninsured mortgages?
Not at this time, no.
Okay. So do you believe the government made the right choice, or did you advise the government when they made the choice on insured mortgages?
From our perspective, the rules from an underwriting standpoint, what is sound underwriting, makes sense to us. If you're taking credit risk new, you re-underwrite. If credit risk stays with the same counterparty, in the case of mortgage insurers, we don't think you need to re-underwrite.
Okay. By definition, uninsured mortgage holders are less likely to default. They have more equity in the value of a house. Why are we asking uninsured mortgage holders to effectively cross-subsidize the mortgage rates of insured mortgage holders?
Mr. Chair, what we ask financial institutions to do is underwrite new credit risks. I acknowledge that there is an imbalance from the experience of a borrower who doesn't have mortgage insurance as opposed to one that does. It's an imbalance we accept because of the sound underwriting principles behind it.
Okay. If the government has made a choice on insureds, we're creating a two-tier kind of borrower where the borrower that has less risk to default actually it has more strenuous stress test requirements. In 2021, when stress test came in, I supported that because it made sense because rates were at an absolute rock bottom level. We're now at the top of the rate cycle, which is according to central banks. Shouldn't we be giving consumers a little bit more flexibility to shop to get a better rate?
Mr. Chair, our mandate is prudential to ensure that the lenders who provide mortgages are safe. We think in maintaining sound underwriting policies, which includes re-underwriting or underwriting new credits, even if they're switching from another institution, that's the appropriate thing to do.
Okay. Thank you. I'd like to talk about Basel IV for a second. The Fed has been very clear. They are making material changes, may even include delaying, may even put out new rules for comment again. They said they have never seen as much feedback on these new rules as possible. Why is Canada sticking to an accelerated timeline to implement Basel IV?
Mr. Chair, in implementing Basel IV, we also call it Basel III Endgame, but in implementing the new changes from Basel, Canada has is actually behind its initial schedule, but ahead of most of its peers. We moved on these because they're based on sound prudential principles that lead to a more stable financial system in our view. With respect to the final leg of the changes we're making, which is known as the standardized floor, which very complex, but it's basically a check on the models banks use to allocate capital. We are well ahead of our peers. And over the last 9 months, it's become quite evident that our lead will at least stay the same or increase. And for that reason, we've been engaging with industry to consider what the right schedule should be for that rising floor. And we'll have more for you on that this summer.
Thank you very much. So you're aware that at least some banks have said in the Canadian context, it may require banks to shed about $270 billion of risk-rated assets. Like, you don't dispute that that may occur?
Mr. Chair, my math doesn't quite align with that math. But what is indisputable is that a rising floor will increase risk weights, which will therefore increase capital. And while we think that is a sound approach, it is imbalanced with our global peers. And that imbalance, the industry players argue that is an imbalance we need to look at. We would agree with that, and we've been looking at it.
Last question before the chair cuts me off. Will you commit to not making a decision until we see what the U.S. decides to do?
Mr. Chair, I don't want to make any firm commitments here today until we're done with the due diligence behind this process, but perhaps I could come back to that answer later this summer.
Thank you very much.
Thank you, MP Chambers, and now to MP Baker.
Thanks, Chair, and thanks, Mr. Rutledge, for being here today. Just for the folks who are watching at home, for constituents and Canadians who aren't familiar with you and the organization and what you do with OSFI, could you just share very briefly, because I have a few other questions, what is OSFI's role? What is your supervisory and regulatory role?
Basically, Parliament asks us to do two things. Ensure the institutions we supervise are in sound financial condition, and ensure they have policies and procedures in place to protect themselves from threats to their integrity and security. That's it.
What would happen if they weren't in sound financial position?
What would happen if they were not?
Were not. What would that mean to Canadians if they were not?
Well, if we're doing our job right, we see that coming, and we oblige boards of directors to take prompt corrective action to forestall that.
Sure. But why should Canadians want? I mean, this may be a straightforward thing from your perspective, but just so people understand, what are the consequences of one of the banks or multiple banks not being in a sound financial position?
Mr. Chair, you to answer that question, just go back to 2007 and 8 in the United States, and you saw substantial across-the-board weakness and sometimes failure of financial institutions, which contracted the availability of credit, which then contracted the economy and led to unemployment.
Yeah. So basically, a lot of economic hardship for Canadians if the banks aren't in a strong financial position.
Yeah.
Right. Okay. And so, what are some of the steps that you've taken to cool the housing market? And let's start with there. Let's start there. What are some of the steps you've taken to cool the housing market? Because as you know,
right,
my constituents, all our constituents are struggling with rising housing prices.
Mr. Chair, I would reframe that slightly to say we've taken steps to make the mortgage credit system a little bit safer, which in turn may cool the housing market. But our primary objective is credit quality. So what we've done is we put in place underwriting standards, mortgage underwriting standards that we oblige all banks to follow, which causes them to make safer mortgages, which then sustains and makes their institutions more resilient. The key thing that we do, and the most important thing we do, is we set a common baseline. If all competitors in the system think they're all following OSFI's sound underwriting policies, then they themselves will follow sound underwriting policies. If we don't have those in place, they'll think, well, my competitor across the street's cheating, so I'm going to cheat because I have to compete. And so there is a game theoretic aspect to what we do. We put a baseline of sound underwriting standards in place to sustain the system through ups and downs.
That makes sense, but let me sort of challenge that a little bit. I mean, some of my constituents have said to me, well, look, like, if we could make it easier for me to get a mortgage or allow me to borrow more, then I could afford to buy a house I wouldn't otherwise be able to buy, or I'd be able to stay in the house that I'm currently in and now can't afford to stay in because my mortgage rates have gone up. And so, wouldn't it help Canadians if we effectively loosened the reins a little bit and made it easier for them to borrow?
Mr. Chair, loosening the reins will typically mean, at least as I interpret it, lessening or lowering underwriting standards. In an individual's case, you're right, someone might be able to get a little bit bigger house or stay in a house that interest rates have made more difficult to afford. But over time, we would be building credit risk in the system that would ultimately, in our judgment, metastasize into a broader financial stress event that would be costly to Canada in the long run.
What I hear you saying, and I don't want to put words in your mouth, like tell me if this isn't correct, but what I hear you saying is you're focused on making sure that the banks are in a secure financial position, because if they are not, we could face tremendous economic hardship, as you described. You described an example of that as to what happened in 2008. And so that is, but it is in pursuit of that goal that there are some restrictions that you require banks to put in place in terms of how much they could lend to certain individuals, even though that's harder for some Canadians makes it harder for some Canadians. Is that correct?
Mr. Chair, I'd agree with that. 2009 and 10 teach us that this resilience of Canadian banks produced a less severe recession in Canada than peers.
So I understand the part about making sure the banks are in a strong financial position. Like, I was in the U.S., I was working in the United States when around that time, 2007, 2008, and I remember, the banking crisis there and the economic hardship that Americans and Canadians felt, but especially Americans felt around that time. But I think what I'm asking is it sounds like you need to find a balance, right? Because you could be even more restrictive on the banks, right? That would mitigate risk even further of the banks having economic hardship, but that would make it harder for Canadians to get mortgages. So am I right that you're trying to strike a balance at all times?
Mr. Chair, yes. And our Act obliges us to do so. It instructs OSFI to allow banks to compete and take reasonable risks. And that is a check on what we do.
So last question then. So how do you respond? Because there are people out there who have been critical. How do you respond to the criticisms that recent guidelines that OSFI has put in place end up hurting Canadian consumers, and especially because they make home ownership more difficult to attain?
Mr. Chair, my response to that criticism would be we're making home ownership more safe for Canadians over the long run so that the system overall produces long-term outputs that are good for the country, which is people buy homes, they pay down their mortgages, and they stay in their homes even when there's a recession.
Thank you, and thank you, MP Baker. And now we're going to go to MP Trudell. I'll just say that, so many members that are not permanent members of our Finance Committee always want to come to Finance Committee, know how hardworking we are here, and we have so many special witnesses. We also have MP Hoback is with us, MP Kayabaga, and welcome to all of you to Finance Committee. And now MP Trudell for 6 minutes, please.
Merci.
Thank you. Thank you, Mr. Chair. And thank you, Mr. Rutledge. I heard you speak French earlier, and I was very pleased. Maybe you'll be able to answer to all my questions in French, but regardless, the important is that you spoke French a little bit, but I'd like to talk about the housing crisis. We know that housing is the most important expense for households. It's a huge cost. We are in the middle of a horrible housing crisis. Last year, I did a tour throughout Quebec to document this, to meet with people who are helping people who have housing issues, and the situation is very difficult. Each and every day, we see tent encampments in different Canadian cities, Vancouver, Toronto, Montreal, and now we even see this in very small municipalities in Quebec where no one had ever seen a tent encampment. And so here we hear that we need to build 5.8 million housing units in the next 7 years. In Quebec, the best year for construction of housing units was 70,000. So in Quebec, we need 1.2 million housing units. So between now and 2031, we would have to find a way to build an ecosystem assisted by governments, and that's what we're hoping for, to build 3 times more housing units that we've ever built in the past. So the challenge is huge. So first of all, I'd like to ask you, since the banks are going through these studies and the banks are saying this, the figures are coming from banks, 5.8 million housing units. I have not heard one single politician say, okay, we're going to find a solution. Because it's huge. We need a type of Marshall Plan for this. It's flabbergasting. All levels of government should be sitting together to try to say, okay, here we have a huge challenge, and we're talking about people sleeping in the streets and single mothers. We saw in Gatineau last year a young pregnant lady, and she had to give birth in a tent in the middle of a city in Quebec. And how can we accept this as a G7 country? I personally don't accept this. And so how is it possible, or your office or financial institutions, how could you advise government, or how could you set forth policies so that we could at least hope to dream that we'll get closer to this objective of 5.8 million housing units in the next 7 years?
Monsieur le Président,
Mr. Chair, I do agree with the member. We need a strategic plan to build more housing units here in Canada. I'm trying to improve my French, so I'm better in English. I'm going to switch.
I agree with the notion that we need a national effort to bring our housing construction up to the level of household formation. And in my first year as superintendent, I gave a speech and I said a major potential risk is that our household formation well exceeds the amount of construction, household construction in the country, and that presents a long-term potential risk to the financial system, and I still hold that. There has been progress made, and I'm optimistic, but we have to do more to bring housing construction up to household formation. And when that happens, the stresses in the housing market, which make homes more difficult to afford, will lessen.
Soyons plus techniques. Est-ce que vous pensez, vous, que...
Let's get a little bit more technical now. Do you think that simply building housing, any type of housing units, because housing is being built in my riding in Longueuil, condos are being built, $2,000, $3,000 a month. So people who have revenues, well, the housing crisis exists for the middle class down. People who have 150,000 in revenue, technically, they are able to afford condos that are being built. So do you think that simply building a housing, regardless of the form of housing, could bring forth, could reduce housing costs? If we had a strategy for building these 5.8 million housing units, could this stabilize the market? Could we find a certain amount of affordability for those who have middle class or even lower income families?
Mr. Chair, the housing, because of this imbalance between household formation and housing construction, housing has been imbalanced, and prices, when demand is greater than supply, prices go up. If we had a constructive strategy that was useful for the federal government and useful for provinces and municipalities, and led to responsible but more homes being built in a responsible way, the supply-demand pressures would abate, in my view, and price pressures would lessen, and that would address the affordability concerns that Canadians face today.
Merci, merci MP Trudel. And now we'll go to MP Davies for 6 minutes.
Thank you, Mr. Chair. Thank you, Mr. Rutledge, for being here. On May 22nd, OSFI's annual risk outlook for the fiscal year said the following. Of the mortgages outstanding as of February 2024, 76% will be coming up for renewal by the end of 2026. Canadian homeowners who will renew their mortgages during this time period could potentially face a payment shock. If you could, Mr. Rutledge, could you quantify the impact you expect this potential payment shock will have on the rate of residential mortgage loans, either falling into arrears or defaults by the end of 2026? In other words, are we facing a mortgage renewal cliff?
Mr. Chair, I wouldn't use that analogy to talk about the refinance risk that's present. For mortgagors who have taken out 3 to 5 year fixed mortgages and face renewal over the next 2 to 3 years, the stair step up in higher mortgage costs will be more manageable in the 15 to 30% range, just depending on the timing of their last mortgage. And so far, it appears to us that Canadians are managing that increased cost. There is a small component of the mortgage market of mortgagors who, in particular during the pandemic, took out variable rate mortgages that had fixed payments. Those folks could face mortgage payment increases of around 50%. It varies by mortgage and timing, but 50% is sort of a good ballpark. That is a very significant shock to monthly finances, and one we're very concerned about. Now, we have an early indicator on that risk, and that is people who took variable rate mortgages with variable payments. By and large, they're managing that rising cost of interest, but their delinquency rates are higher than people with fixed. But it is not dramatic, it is incremental.
So what impact, if any, do you expect that an increase in residential mortgage loans falling into arrears or defaults will have on housing prices in Canada?
Mr. Chair, hard to predict the future, but I'll try and give some perspective on that. The issue right now, the prior member spoke about, which is supply-demand imbalance, means that if we had more than normal level of foreclosures and therefore greater amounts of supply on the market, demand conditions are such that it would likely take up much of that supply and housing price pressure would not be as significant. And I would point folks to the house price indices, which although they've been flat for 2 to 3 years, haven't fallen despite a very substantial increase in interest rates.
I want to shift to other kinds of credit if I could. On May 29th, a news release from Canadian Mortgage and Housing said the following. For the first time since the beginning of the pandemic, mortgage delinquency rates are trending up. Vulnerabilities first detected in credit card and auto loan markets are therefore moving into the mortgage market as well. This suggests the financial buffers built up during the pandemic are becoming exhausted by some households. Do you agree with that assessment? And I'm curious what comment you may have on that.
Mr. Chair, yes, I do. That's what the data indicates. What we're seeing is that rising mortgage costs and rising interest rates are first impacting households that tend to have a little bit less income. So, say in the lowest quintile of households. Those households typically do not own homes, but they do have credit cards and car loans. So we are seeing rising delinquencies in that space. And that is a concern. What I can tell you is that the financial institutions we regulate are absorbing those higher credit costs without material threat to either their earnings or their capital.
Now, OFSI also commented in May, they said the following: changes to the economic environment, such as weakening labor markets and declining rates, could reduce the payment shocks outlined above. Could you elaborate on how the combination of weakening labor markets might impact the risk associated with real estate secured lending and mortgages?
Yeah, Mr. Chair, weakening labor markets would, if history is a guide, likely be followed by falling interest rates, which would then in turn lower the refinance risk faced by current mortgagors.
And if interest rates are reduced, does this not have a risk of restarting the cycle of cheaper money, putting more people in the market, therefore putting additional price pressure on housing?
Mr. Chair, the answer to that question is yes, it does. And we implemented a policy recently on mortgage underwriting that will check the tendency of banks and homeowners to lever up in that environment. And that check is known as the loan-to-income ratio test.
Mr. Chair, do I have time for one more question? Okay, I'll throw it out there.
MP Davies, go ahead, please. Yes. Sorry.
Thank you. Mr. Rutledge, you talked about the impact of variable rate mortgages. In your view, have Canadian financial institutions taken sufficient steps to date to mitigate the risk associated with variable rate mortgages, especially those with fixed payments?
Mr. Chair, my answer to that would be a qualified yes. The folks we're particularly worried about, so folks who have that product that have negatively amortizing mortgages or interest-only mortgages. The numbers over the last 18 months have fallen from about 270,000 households to about 175,000 households. That is a result of households and financial institutions taking preemptive steps to avoid more problems later down the road.
Thank you, and thank you, MP Davies. And
thank you.
That is the time. And now, members, I'm just looking at the time. We do have enough time for a full second round. In this round, we're starting with MP Lawrence for the first 5 minutes.
Thank you, Mr. Chair. Thank you for coming today, Mr. Rutledge. Really appreciate it, and I think Canadians will be glad to hear from you as well. There are risks and challenges whether the housing prices go up or go down, right? And sort of keeping it on that narrow path that I believe is one of your goals there. So I want to talk specifically though about the capital gains and of course the increase in the inclusion rate of capital gains and the impact that this will have on the housing market. So first of all, I want to talk about the way that the Liberals designed the implementation. Of course, that creating conditions for a fire sale up until June 25th, which is just around the door. Of course, that's going to, in my mind, if you're a cottage owner and you want to get the lower rates of the inclusion, you'll want to sell before June 25th. Do you think that this will have any material impact on the prices? And obviously, if the housing prices go down, that puts the risk of mortgages going underwater. So.
Mr. Chair, I think it's a little dangerous for me to comment on tax policy, but I'll address the question about the housing market and the effect of a sudden burst of supply. So if there were a sudden burst of supply in any particular regional market and demand was the same, it'd be downward price pressure. We have not seen that phenomena yet. in any of the major markets we cover. I'd have to come back to you on specific, more local markets.
Thanks. Thank you for that. And I'll maybe frame this question towards more generality, so it might be a little bit easier for you to respond to. But the other question I want to ask is also relative to tax increases. This is on home building. Your testimony earlier was that we need greater housing construction in order to bring housing prices back to reasonable levels of affordability. If, in fact, a government increases taxes of any sort, that will, of course, will reduce or limit supply depending on the amount of the taxation of various other factors. Is that correct there?
Mr. Chair, you're asking me an economic tax policy question. I'm just superintendent. Marginal increases in the cost of housing construction, I have not seen cases where that has materially impeded supply.
Right. Okay. So maybe I'll just go a little bit further on that, if I could. If it's not marginal, though, if it's material cost, the increase in the inclusion of the capital gains rate could cost a developer millions, if not tens of millions of dollars. And often these projects are marginal. They might be $1 million or $2 million either way, whether you go ahead or not. Surely you'll agree with me, Mr. Rutledge, that now is not the time to put in additional barriers for builders to build houses when, as the president, I believe, of the home builders said, there's not a chance we're going to hit our target.
Mr. Chair, I'm going to politely refrain from entering policy debate around tax policy. I will stand by my earlier statements about the importance of bringing supply into line with demand in terms of housing and household formation.
Okay. Thank you for that, and I do appreciate you trying your best there. But I just want to put a little bit. I'll switch subjects here a little bit around the sensitivity of interest rates with respect to the housing market. So, if in fact, like I said, we can get in trouble if houses go too low or too high. Are you concerned that a dramatic decrease, we've got 0.25, barely anything, but if in fact the Bank of Canada were to move too quickly, that might drive the housing prices too high? And are you comfortable with that now with the 4.5 rule or the 450% rule that we'll be able to protect ourselves from buyers taking on too much?
Mr. Chair, I think the advantage of this LTI requirement that we're putting in, I should mention it's just for institutions. It doesn't affect individual borrowers. But what it would do is that if rates did fall very low, it would act as a backstop to the mortgage stress test and tend to limit the amount of excessive risk-taking in the mortgage space.
Okay, and what about right now for the payment shock that you've talked about in your report there? If in fact the housing market caught fire again because of the interest rates or whatever, what's your level of discomfort? Is it if the housing market went up 10%, 20%, 30%, where we would start seeing issues with the housing market there?
Mr. Chair, if we saw a significant increase in prices, the problem that I've spoken to with respect to variable rate mortgages with fixed payments would actually lessen, because people facing those higher payments would have a more robust market in which to sell their homes and therefore cure their debt service issues.
Thank you, and thank you, MP Lawrence. And now to MP Zarowitz, please.
Thank you, Mr. Chair, and thank you, Mr. Rutledge, for being here today, and thank you for your service to our nation. At a breakfast that a number of us attended yesterday with Bank of Governor officials, we were talking about housing, and I learned that in a number of different countries, they do very different things with mortgages. Some countries allow you to port mortgages over 8 years and 80 years and a number of generations. Some countries like the U.S., you could lock into a 30-year mortgage, but you have tons of flexibility in terms of how much to pay off your mortgage at any one time. And so my question to you is, have you been in touch with other regulators around the world? And is there anything we could learn from them or ideas that perhaps we might want to consider adopting here as we're trying to struggle with the affordability and housing crisis we have right now, that you might be able to contribute to this conversation here today. Thank you.
Mr. Chair, every country's mortgage system is a reflection of its history and its regulatory policy. I would start by saying Canada's mortgage system has worked quite well. Many of my peers are envious of the track record of credit quality in our mortgage system. A hallmark of it is we have relatively shorter amortization periods. So people pay down their mortgages, and the lower your debt goes, the less risky your financial situation is. When you have longer mortgages, your debt stays around for longer, and it is a higher risk issue. The Bank of Canada has done interesting work on how to improve our marketplace to make longer-term mortgages available. So if households, if they so choose, can term out their mortgages for longer than 5 years at a reasonable price. They can do it right now. It's just the prices are fairly expensive. And I'd refer you to them. They've done a lot of good work, and they have a lot of good ideas. And in aggregate, if the product set evolved in that way, that would be a net benefit to the system because it would give mortgagors more choices to manage their personal financial risks.
Appreciate that, and I do appreciate the work that the team at the Bank of Canada is doing around this. I think it's at a time where we're moving into a different era where house prices are very high and will probably continue to be very high moving forward. So how is it we can provide flexibility for Canadians in a way that doesn't sacrifice the credit quality of our banks, but allows us to live in an affordable way and continue to own homes? My colleague earlier today was talking to you about the stress test. In the early days of the pandemic, we heard from CMHC, the head of CMHC then, and we talked about the stress test and how important it was in order to ensure that during a time of emergency, global emergency and global crisis, many people would continue to be able to keep their homes because of that stress test. Would you agree that the stress test helped us during the pandemic and thereafter to continue to allow Canadians to be able to afford their homes?
Mr. Chair, the mortgage stress test did improve credit quality during the pandemic. And more critically, I have been pleasantly surprised at the very low level of delinquencies in Canadian mortgage space. And I attribute that to 6 years of mortgage stress test, primarily.
Thank you. I appreciate that. Our latest budget has introduced open banking. Most countries have had open banking for a number of years. I think Australia is on their third or fourth version right now. And I wonder whether, from your perspective, from OSFI's perspective, there's any additional work that you need to do to continue to ensure credit quality within our financial institutions because of open banking, or any other work that you feel you need to be doing or thinking about moving forward?
Mr. Chair, two-part answer. The first part is we saw it coming and we developed a regulatory guideline on third-party risk management, which should help the banks we regulate manage new relationships that will come as a result of open banking. Longer term, we have to be watchful that those new players, that if they do decide to innovate beyond their immediate business model, which is to enable customers to own their own banking data effectively, if they move from that model to one that involves taking deposits and making loans, that they do that in a regulated space. If we let that activity go unregulated, we see that usually leads to bad outcomes.
Thank you.
Zerowitz, and now to MP Saint-Marie for 2.5 minutes.
Oui, merci, Monsieur le Président.
Thank you, Mr. Chair. I'm going to begin with a point of order. When the Bank of Canada appeared before the committee, a few of us MPs asked questions, and he said that we would have written answers. Mr. Morantz, Mr. Chambers, myself, and others, we received an answer last Friday, and so I'd like to make sure with you and the committee that we're able to use these answers, that they be made public, and that we be able to use them as if the bank had given these answers during the committee session.
Bon.
Yes.
Très bien.
Okay. Members, yeah. Yes.
Merci, monsieur.
Okay,
Merci,
MP
monsieur.
Thank you, Mr. Chair. So, Mr. Routledge, thank you for all your work, and thank you for being here today. The Canadian Bankers Association calculated that last February, 0.19% of mortgages in Canada were delinquent, so that the payments were not made for 3 months. And how do you expect that this proportion will increase due to the large amount of mortgages that will renew between now and 2026? How, with this mortgage default, how might it lead to a loss for financial institutions, and what measures are being implemented in order to reduce these risks?
Mr. Chair, that's correct. 0.19% is the delinquency rate. To put that into context, we've seen that rate go as high as 1.00%, so it's still fairly low. Yes, unfortunately, I do expect that rate to continue to go up as Canadians renew, and some have difficulty with that. What we've done is put in place some pretty serious capital rules or capital expectations to ensure banks have buffers to absorb losses bigger than they expect. From what we're seeing, the delinquencies and the losses they're producing are a low enough level that the banks, particularly the large banks, will handily absorb those losses through their earnings.
MP Samari, and now we will hear from MP Davies for 2.5 minutes.
Thank you. I think if I have this right, there's been a recent decision to increase amortization periods to 30 years. What impact might that have on your analysis?
Mr. Chair, I believe the member refers to Budget 2024, and in some cases, for first-time homebuyers, they'll be able to take 30-year mortgages out if the mortgage is insured. Net, that will increase buying power of home buyers, and it's a very, very limited increase. It's first-time home buyers. But if your mortgage amortization period goes up from 25 to 30 years, your monthly payment goes down, so you can afford more house.
But doesn't it also bring more people into the market, thereby increasing demand?
Yes, at the margins, that would lower the monthly mortgage costs, and therefore you might open up the market for more buyers. However, home sellers know this. And what I expect a rational home seller to do would be, in realizing their people looking through their house at an open house have a little bit more buying power, I think they'll increase prices, and I think the benefit will be relatively short-lived.
Thanks. Finally, I think we've recently, in the last couple of years, put a ban on foreign buyers in the residential market. I'm just curious if you have any comment on that. Are we seeing any consequence or impact of that yet?
Mr. Chair, that ban is fairly limited, and so we haven't seen any real effect on housing demand from it.
I'll flip that around. What's been the impact of foreign capital in our residential markets in Canada over, say, the past 10, 15 years?
Mr. Chair, not to be overly technical, what is foreign capital is foreign capital. Certainly, it's someone who doesn't live in Canada buying a house in Canada. But
that's what I mean.
Yeah, that's low. What's driving demand for housing, though, is new Canadians coming in with financial resources who then buy a home. I don't consider that foreign capital, but it is sourced from outside Canada, and it is adding to demand for housing in Canada.
Thank you, MP Davies.
Thank you.
And now we'll hear from questions from MP Morantz for 5 minutes.
Thank you, Mr. Chair. Thank you for your testimony today, Mr. Rutledge. It's been very interesting. One of the things that OSFI regulates are basically the capital reserves of the banks. What I think you call the domestic stability buffer. What ordinary Canadians could kind of think of as money set aside for a rainy day. And last year I note that, I assume out of concern for the stability of the banks, you increased that requirement from 3 to 3.5%. Now, the language that you used in your report recently, calling when people refinance or have these variable rate mortgages, when their new payments get locked in, payment shock, that's very strong language. You don't use that language unless you're really concerned about something. Now, today it sounds to me like you've kind of poured a little water on that because you kind of narrowed it down to just people who are on the variable rate without locked-in payments. But I still have a couple questions. Are you concerned enough to increase the domestic stability buffer again this year? Or are you satisfied that people are coping with their payments sufficiently that you could actually reduce it back to 3%?
We intend to make an announcement on the domestic stability buffer next week, so I won't scoop myself. What I can refer
Oh, come on, just tell us.
what I can refer you to is that in December of this year, we said that the vulnerabilities had stabilized, and so there was no need to raise the buffer any further. And on empirical data, vulnerabilities have not worsened since that time.
So why use that language? It's clearly inflammatory language in a public
Payment shock?
report. Yeah, why use that language? I mean, you don't use it unless you're concerned about something. It doesn't sound like you're all that concerned based on your testimony here today.
Mr. Chair, I guess we use the language because that's how we talk about it with the institutions we regulate. That's the language they use. Now, the payment shock, the folks that are exposed to particularly acute payment shock are relatively, it's not a lot of people. I mean, 170,000 I acknowledge is too many, but there's 5 million Canadians with mortgages. And so the issue we have with that risk concentration is, it will harm Canadians. It will, the Canadians who have those mortgages, if they do suffer that payment shock, it'll strain the earnings of the institutions. And it is an unnecessary risk concentration that all else equal I would have rather avoided. And I use the term because that's what we use in the industry, to be honest.
I just circle back to a line of questioning that Mr. Chambers was asking about earlier. You admitted that there's an imbalance, that people with uninsured mortgages have to have their credit reassessed, and those with insured. It really is kind of backwards, when you, as Mr. Chambers pointed out, that people who have better credit and more equity in their homes have to go through that. You're saying here there's an imbalance, but at the same time you said you don't plan to do anything about it. So you're okay with a certain group of Canadians being treated unfairly when it comes to their mortgages compared to people who have insured mortgages? That's okay with you?
Mr. Chair, I'm okay with banks applying underwriting standards equivalently across the system. If we were to lighten underwriting standards vis-a-vis the MQR, well, that comes from Guideline B20, which also calls for new credits to have the collateral appraised, to have the income of the borrower checked. In other words, if you loosen one underwriting standard, you're probably going to loosen more. And our mandate calls on us to be fairly vigilant on this. My recognition that there is an imbalance from the perspective of homeowners who have insured versus uninsured, I hold to. It is, from the perspective of those home buyers, if I were a home buyer facing that, I would feel like it was an imbalance. The Commissioner of the Competition Bureau and I have spoken about that. And I think it is a legitimate challenge to say to OSFI, can you do something different so that imbalance goes away? We are thinking about it, and I think it's a fair critique.
Great. Thank you.
Thank you, MP Morantz. Okay, for our final 5 minutes for the superintendent, we've got MP Sorbara, please.
Thank you, Chair, and welcome everyone. And Peter, nice to see you again. I think if I age you and age myself, we would go back about, say, 12 years. And I know you've had a number of roles, from being a bank analyst at Moody's and now to this position at OSFI. So congratulations on your career path and your appointments. Very well deserved. I still remember listening to you on the conference call, on the bank analyst conference calls with the bank earnings, and I was on the bond side and you were on the equity side. Peter, the one thing that we know about the banking industry and with regards to liquidity and funding, and we know when there's a banking crisis, it always comes down to liquidity and funding, and you can even take that to the consumer side as well. I've read the annual report and I've sort of skimmed over it and stuff. On the funding and liquidity risk side, what's your view on that with regards to the Canadian banking system?
Mr. Chair, we had a stress test of that in 2023, and I don't think it'd be right to say I'm surprised, but I was certainly reassured that during that period, Canadian banks, by and large, were safe haven investments. In other words, they tended to see positive inflows. And that would extend to smaller and medium-sized banks who to be candid, we had extra vigilance over, and we saw very stable funding flows to those institutions. So a safe, regulated system with a lot of capital and liquidity buffers is viewed by international investors as a safe haven system, and it's an asset that I want to do my part to protect.
Okay. With regards to digitization and any sort of, digital currency, open banking, portability, what of those things, if I can use it in this term, keeps you up at night and makes you think about, because OSFI has a mandate, you can try to quantify risks, and that's the best way we can do with arrears and so forth and domestic stability buffers. But on that side there, how should we as legislators think about that side?
The risk that keeps me up at night is you'll get unregulated business models emerge that compete directly with regulated institutions. For example, there are some stablecoin arrangements that, when I look at their balance sheet, look an awful lot to me like banks. They take deposits for a very short period of time and they make long-term investments. Those institutions, if they have that balance sheet that looks like a bank, they should be regulated like a bank, and that's what keeps me up.
And I also would like to, I want to add on that, if there's asset liability mismatch on those balance sheets, that would obviously be a cause for concern, would it not?
Mr. Chair, one needs only look at the crypto winter or the case of Silicon Valley Bank to answer affirmatively yes to that.
Okay. If Chair, just please cut me off when my time is up. One final question. Arrears in Canada. We know that Canadians, we know their mortgage debt is backed by